India's political landscape witnessed a seismic shift with the recent election results. The incumbent government secured a resounding victory, returning to power with an even greater majority. This outcome, while widely anticipated by some, sent shockwaves through the Indian stock markets, which were caught off guard by the scale of the win. The immediate aftermath was a sharp decline in key indices, reflecting a mix of apprehension and uncertainty among investors. The market's reaction underscored the deep interconnection between politics and economics, particularly in emerging economies like India. Political stability is often seen as a prerequisite for sustained economic growth, and any perceived deviation from this script tends to trigger market volatility. While India has traditionally enjoyed a relatively stable political environment, this recent episode highlights the sensitivity of the markets to shifts in the political landscape. The response of foreign institutional investors, FIIs, often considered the bellwether of market sentiment, will be crucial in shaping the future trajectory of the Indian economy. Their investment decisions are influenced by a multitude of factors, including political stability, regulatory clarity, and the overall health of the economy. Understanding their response to the recent political developments will be key to deciphering the long-term implications for Indian markets. The ruling party's victory was historic in its scale, surpassing even the most optimistic projections of pre-election polls. This resounding mandate, while a testament to the party's popularity, seemed to have taken the markets by surprise. The unexpected margin of victory fueled uncertainty, leading to a knee-jerk reaction from investors who opted for caution over exuberance. The benchmark Nifty 50 index, a barometer of the Indian stock market's health, plummeted by over 4% in the immediate aftermath of the election results. This sharp decline erased billions of dollars in market capitalization, reflecting the widespread anxiety that gripped investors. The suddenness and severity of the market's response underscored the unexpected nature of the election outcome. While the initial shockwaves have subsided, the market's reaction serves as a stark reminder of the inherent volatility that accompanies political events. The interplay between politics and economics is often complex and unpredictable, and the Indian stock market's response to the recent elections is a testament to this intricate relationship. To truly grasp the magnitude of the market's reaction, it's essential to delve into the numbers. The Nifty 50 index, which represents the top 50 companies listed on the National Stock Exchange of India, witnessed a staggering plunge of over 600 points in a single day. This dramatic fall wiped out a colossal 10 lakh crore, approximately $140 billion, in market capitalization, underscoring the scale of wealth erosion that transpired. The decline in the Nifty was mirrored by a similar downturn in the BSE Sensex, another key market index. This simultaneous slump across major indices pointed towards a broader market sentiment, rather than a sector-specific correction. The uniformity of the decline suggested that investors were reacting to the overarching political development rather than any specific policy announcements. The market's reaction, while significant, needs to be contextualized within the broader economic landscape. India's economy has been grappling with a multitude of challenges, including slowing growth, rising inflation, and a widening current account deficit. The election results, while adding to the uncertainty, should be viewed against this backdrop of pre-existing economic headwinds. Section 4. Why this time feels different. India's economic challenges in a new light. While market volatility is not uncommon following major political events, the recent reaction to India's election results feels different. The sheer scale of the market's decline, coupled with the pre-existing economic vulnerabilities, has created a sense of unease that extends beyond the usual post-election jitters. This time, the market's response seems to be amplified by deeper concerns about India's economic trajectory. One factor contributing to this heightened anxiety is the global economic slowdown. With major economies like the United States and China facing their own set of challenges, India's export-oriented sectors are likely to feel the pinch. This global headwind, combined with domestic challenges like slowing consumption and a credit crunch, has created a perfect storm for the Indian economy. The market's reaction also reflects a degree of uncertainty about the new government's economic policies. While the ruling party's economic agenda during the campaign focused on infrastructure development and job creation, the specifics of how these goals will be achieved remain unclear. This lack of clarity on policy direction has contributed to the cautious sentiment prevailing in the market. Section 5. Navigating the uncertain future. Long-term implications for investors. The recent election results and the subsequent market meltdown have cast a long shadow of uncertainty over India's economic future. Investors, both domestic and foreign, are grappling with the implications of this new political reality and its potential impact on their investment portfolios. Navigating this uncertain terrain requires a nuanced understanding of both the political and economic dynamics at play. In the short term, market volatility is likely to persist as investors adjust to the new political landscape. The initial shockwaves have subsided, but the underlying uncertainty about policy direction and economic growth will continue to weigh on investor sentiment. This period of volatility presents both risks and opportunities for investors, depending on their risk appetite and investment horizon. For long-term investors, the current market turbulence should be viewed within the broader context of India's growth story. The country's demographic dividend, coupled with its vast untapped potential, continues to make it an attractive investment destination. However, realizing this potential requires a stable policy environment, structural reforms, and a renewed focus on reviving economic growth.